Hi guys! In today's video, we're going to have a look at another chapter, which is going to talk about profitability and liquidity ratio analysis. So let's have a look at the first part, where we're going to talk about just about profitability ratios. So the gross profit margin and the net profit margin, and the return on capital employed. In general, what is the role of ratios? So obviously we can have a look at our final accounts to see what is the profit of the business, what is the sales revenue, how have our costs decreased or increased. However, ratios help us understand the relative size of our profits, perhaps compared to last year. It helps us identify trends in profitability, liquidity, and efficiency over time. So, for example, we can see to what extent have we improved our profitability this year compared to last year. It helps us control our costs. So, how have our costs increased in relation to our profits, or in relation or relative to our sales revenue? And therefore, it helps us make decisions about investments and growth in the future, and to make comparisons with other businesses in the same industry who would be our competitors. So in a way, the ratio analysis is adding on top of the information that we're getting in our final accounts, and it helps us make comparisons. In general, we split accounting ratios into three types. Profitability ratios, that's the type of ratios that we're going to cover in this video. Then liquidity ratios, and finally the financial efficiency ratios, which is a higher level topic. When it comes to the profitability ratios, in general, they measure the relative profitability, or the relative ability of a business to make profit. And obviously, the first one would be the profit margin ratios. These can be split into two types, into gross profit ratio and net profit ratio. And they assess how successful the management of a business has been at converting sales revenue into both gross and net profit. And based on that definition, this is the equation, how we calculate it. So gross profit margin is going to be calculated using gross profit at the top, divided by sales revenue times 100. It's going to be given as a percentage. And the net profit margin is going to be calculated very similarly. It's the net profit divided by sales revenue times 100. The good news for you is that you won't have to remember how the ratios are calculated, because they'll be given to you in the formula booklet. So in the exam, you can have a look how these are calculated, and this is the information that you'll be given. What you won't be given is obviously everything around it. So how to find out gross profit, how to calculate gross profit, how to evaluate the different ratios. And this is what you need to be able to understand and write in the exam, talk about in the exam. Now, looking at gross profit and net profit, the best way how to see is to look at an example. So in this particular example, at the top table, we are given two different companies, and we're given their data on their gross profit and their revenue. Obviously, each business, as you can see, is of a different size. Nairobi Press Ltd will be probably a smaller business. It has much lower revenue than Port Louis Press Ltd. And now, if we were to somehow compare the profitability of these companies, for example, we are an investor, we're deciding whether to invest in the smaller business or in the bigger business, and we want to know which business is doing better, which one is more profitable. So what can we do? Obviously, the gross profit margin would be one way to calculate which business is going to be more profitable. So in order to calculate the gross profit margin, we take the gross profit divided by the revenue times 100. And as you can see, Nairobi Press Ltd is going to have a gross profit margin of 50%. Port Louis Press is going to have a gross profit margin of only 25%. So when it comes to the gross profit margin, it looks like Nairobi Press Limited is more profitable. However, we can then compare also the net profit margin. And as we know, the net profit already has the overhead costs deducted from it. So in this case, the Nairobi Press Ltd is still doing slightly better because its net profit margin is 20%. However, it's not that much of a difference as it was with the gross profit margin. So it looks like the Port Louis Press Ltd is, let's say, more efficient when it comes to managing their overhead costs. However, it's still not enough because their net profit margin is slightly lower. So this is a great example to see the point of why we have ratio analysis, because it helps us or enables us to compare different companies. We can also use it to compare different years. And it shows us the relative success, the relative ability of the two companies to turn their sales revenue into profit, which is basically the definition of profitability. Now, what would be some strategies or some ways how to improve profit margins? Well, let's have a look at the ratios again. How would I try to improve my gross profit margin? How do I make this number bigger? So let's say I have 15% and I want to increase it into 20%. I want to increase my gross profit margin to be 20%. Well, one way obviously would be to increase gross profit, relatively to sales revenue. I need to increase my gross profit relative to sales revenue. Okay, so that can be, let's have a minute to think about the different ways how we can increase gross profit relative to sales revenue. If you want more time, please stop the video, try to think of some strategies, some methods how to do that. However, we're going to move on and actually find some answers to this question. The second way is going to be similar, how to increase net profit margin. Well, we need to think about how do we increase net profit compared to sales revenue. So increasing the net profit without necessarily increasing the sales revenue as much. So in the first example, how do we increase gross profit? Well, the first thing that might help is to look at or revise how we calculate gross profit. So this is just an excerpt from the profit and loss account. Obviously, the profit and loss account is continues. There's interest and tax deducted and dividends deducted, and the final we have retained profit. However, for this analysis, for the analysis of gross profit margin and net profit margin, we only need the first five sources of data. We need to know our revenue, the cost of sales, gross profit, overheads, and the net profit, or in other words, the profit before tax and interest. It's also helpful to remember how gross profit is calculated. So obviously, revenue minus cost of sales equals gross profit, right? So this is just a quick revision. Now, the question that we were asking ourselves at the beginning, how do we increase gross profit margin ratio? We can only do that by increasing gross profit. So now, if I want to increase my gross profit, what are my options? So one way is to actually decrease the cost of sales. Yeah. Let's say that instead of deducting, $1 for simplification, I'm going to deduct $0. Then obviously my gross profit is going to increase. Yeah. So how can we sort of decrease our cost of sales, our cost of goods sold? Now, the strategy would be called cutting the cost of goods sold. And some examples of that, well, it can be either by using cheaper materials for a product, bargaining with our suppliers, maybe to get better deals, even for the existing materials. However, it can also be done by cutting labor costs. Either we can do that by offshoring to a country with lower incomes, or, for example, we can also cut labor costs by investing into automation and getting some machinery, which is going to do our workers' jobs, or simply just by reducing our workers' pay. These are all different examples of the strategy, how we should cut the cost of goods sold. Now, obviously, the question is examples, is this strategy always going to be a good option for the business? Well, it depends on the business. So we always need to evaluate the strategy. So what can happen if we use cheaper materials? Well, one disadvantage is that the quality may go down. Customers are going to notice, they're going to be upset. This is going to damage our reputation, maybe even lower sales. So this is just one of the possible drawbacks of this strategy. It might not happen, but it also might. So this would be an argument which you could use in an essay where you would evaluate such strategy. Another example, what can happen is if you buy some machinery in order to automate your production, then yes, this might decrease gross profit because you're not going to have to pay any workers. However, it might increase your overhead costs. And if that happens, then your net profit will fall. So it will have a different effect on your net profit. Also, if you reduce workers' pay, or if you decide to move to a lower income country, the motivation of your current workers can fall, and this might lead to either lower productivity and or lower quality. These are just some examples of how you can evaluate this particular strategy. Obviously, it has its benefits, but the idea is, as I'm going to show you later, is to always find the balance in your arguments. Okay, what could be some other strategy? So instead of cutting cost of sales, in order to increase the gross profit, we can also focus on increasing the revenue. And as we know, revenue equals price times quantity. So if I'm going to keep quantity the same, and I just want to increase the revenue, the only other option is to increase the price. So this would be another example of the strategy, increasing price. The idea is you always would like to increase the price more than you're increasing your variable costs. So you might increase your price, for example, by adding some new feature to your existing product. For example, you're selling, cappuccino, and you add some kind of flavor to it, and suddenly you can sell that product with a premium. So you increase the price of that flavored cappuccino, but the idea is that you should increase the price more than your variable costs have increased. Obviously, the businesses do that quite a lot. The valuation of this strategy is that often the higher price might actually lower sales in case that the customers are, demotivated by your higher prices and they like to switch to competitors. If your higher price isn't that visible, or your customers don't mind as much, then obviously this can work and it can increase your revenue and no customers will switch. However, it might happen. Also, this might damage if your increase in prices is considered as profiteering, then this might damage the long-term image of the business and you might lose trust of your customers. So this was another second strategy of how we can increase gross profit margin. And the third example, and this example is already going to focus not on the gross profit margin, but the net profit margin. So how can we increase the net profit? Obviously, any strategies that worked for the gross profit most likely are going to work also for the net profit, unless you are investing in overheads. So the idea is that in order to increase net profit, you need to increase gross profit, but also cut overheads. So how do we cut overhead costs? Well, at the beginning, we need to realize what are some examples of overhead costs. So if you cut rent, sure, that's possible. You can, for example, move to a cheaper office, to some cheaper area. That is going to decrease your overhead costs. Also, you can cut on promotion costs, lower advertising spending. And another example is that you can cut your management costs. For example, by cutting off an entire level of managers, which, as we are going to see in our HR chapter in the human resources unit, this is called delayering. These are all different options or different ways how to execute this strategy of cutting overhead costs. And the evaluation of these different examples could be that, well, if you, decrease rent or basically move to a cheaper office, yes, you will pay a lower rent. However, depending on your product, what you're selling, whether it's some regular good or if it's some kind of premium service, it can ruin your image. So for example, if we're talking about some premium restaurant, it probably should be located at a premium location. Moving to a cheaper area would probably lower your sales and therefore lower your profits. The example of the promotion costs, cutting promotion costs can lead to sales falling by more than the fixed costs. So again, we need to be sensible in where we make the cuts. And the last one, cutting management costs, it can work, sure, but depends on the managers. What is their role in the business? If the managers actually keep the business efficient and they're important for the operations of the business, then it might not be the best place where to do these cuts. So these are just very simple examples of the strategies that you can do in order to improve your profit margins, whether it's your gross profit margin or your net profit margin. And now an exam tip, which I kind of mentioned, but I would like to stress that again. In an exam, do not just state that in order to increase profit margins, the business should increase sales, because that would be a poor answer. We have to go even further. Yeah. Many exam questions will actually ask for methods of increasing profitability of the business. And most of the time, the question might need an evaluative answer. So it is very important that you consider at least one reason why your suggestion might not be effective, like we did in our case. And, it's not enough to say, oh, in order to increase profit margins, the business should increase sales. You have to say how. How should they increase sales? What should they do? Should they increase the price? Should they increase advertising spending? Or, if they don't focus on the sales revenue, and they focus on the costs. How do they cut costs? So it's very important that you're specific and also that you relate to the case study that you're talking about. As we saw with the restaurant, it might be a good idea to, cut rent costs and move to a cheaper area in case of some, regular business, but it will definitely not be a good idea if we're talking about a premium restaurant. Now, the second profitability ratio that I would like to cover, or actually the third one, because we already covered the first profitability ratios, it's the return on capital employed. So the return on capital employed is the most commonly used means of assessing the profitability of a business. It is also called the primary efficiency ratio. Now, why is this one used primarily? Because it actually looks at net profit, which already has all the costs deducted from it. So it has the cost of, cost of sales deducted from it and overhead costs. But it looks at it from the point of view of how much capital have we employed in the business. So it's net profit divided by capital employed times 100. And as we remember from the final accounts unit, capital employed can be calculated in two ways, either as total assets minus current liabilities or non-current liabilities plus shareholders' equity. So non-current liabilities, those are the long-term liabilities, the long-term loan, and shareholders' equity is all the capital that the shareholders have invested in the business. So it's going to be the shareholders' capital plus the retained profit. So in general, capital employed is the capital employed in the business in the long term. And it shows us how well the business is doing using this long-term capital and turning it into net profit. If I have a higher ratio, then I'm more successful in using my capital employed and turning it into profits than if I have a lower ratio. And very often it is used in order to compare with other opportunities of where I can invest my money. So if I know that my return on capital employed is a certain percentage at investing into one business, then I can compare it, for example, with the option of putting my capital on a savings account in a bank. The savings account might have a lower percentage, but then on the other hand, it's going to be safer putting all my capital on the savings account rather than investing into a business whose future is unsure. But then that's the idea, that the return on capital employed needs to be that much higher in order to motivate the investor in order to invest into the business and get a high return on his money. And that is basically what this ratio is looking at. Yeah, so here are some additional definitions of what it means. The total, the capital employed, it's the total capital invested in the business. And again, we should look at an example. So looking at the example of Nairobi Press Ltd and Port Louis Press Ltd again, we see that their net profit values are very, very different. Also, their capital employed values are very different. And I'm, as an investor, I might be asking, so what is the return on the capital that we've employed in these businesses to see which one is more profitable? And yes, Nairobi Press Ltd has much, much lower profit, net profit. However, it also has much lower amount of capital employed in the business, and therefore the return on the capital employed is much higher. So it is more profitable. Here, it's also doing very well. Net profit of $500 million. Very nice. However, I'm employing a much larger sum in the business, and therefore, as a result, I have a much lower return on capital employed. Maybe this is not going to be, as motivational for me as an investor to, risk basically or employ that much capital in this business for a return of just 10%. But really, that actually depends very much on the investor itself or himself. So the return on capital employed, the higher the value of the ratio, the greater the return on each dollar of capital invested in the business. The result can also be compared with the return from interest accounts. So as I said, whether we are going to put it in a bank and have basically no risk, losing this money, can be compared with the interest cost of borrowing finance. So if my return on capital employed is going to be higher than what we pay to borrow the money, for example, on a long-term loan, then that's good. Obviously, if it would be lower, if the return on capital employed would be lower than what we need to pay for borrowing the finance, then it's not worth borrowing the finance. And the idea is that the return on capital employed can be raised by either increasing the profitable, efficient use of the assets owned by the business, which were purchased by the capital employed. Yeah. If we are, for example, owning some assets which are not as useful, that we're not using them efficiently, well, then it might be a good idea to sell these assets, because as a result, this is actually going to increase our return on capital employed. It is going to increase this primary efficiency ratio that a lot of investors are looking at. And the method used for the calculation of capital employed is not universally agreed, and this causes problems for comparisons between companies. So obviously, if different companies calculate capital employed differently, then it might be harder to compare the return on capital employed. So this is one disadvantage of this particular ratio. But in general, you get the idea that it shows you how efficiently the business is using the assets or is using the capital that has been sort of inserted into the business. Some strategies how to improve the return on capital employed. Obviously, you can raise prices of existing products. However, you need to check whether this is actually not going to drive the sales revenue down. As we said, if our customers are very sensitive to prices, then they're not going to be very happy. Also, you might need or want to develop innovative products and set prices high. So that would be a great strategy in the long term. You might reduce variable costs per unit. But as we said, the cheaper materials could reduce quality. Reducing overheads we talked about. You can also increase capital invested in new technology, and this could lead to an increase in net profits higher than the increase in the capital employed. Yeah, but then the idea is that this is also a very long-term strategy, and the finance will be needed, and increase in net profits may be relatively less than increase in capital employed. You might also decide to reduce the capital employed. So as we said, if you have any assets which are not contributing anything to the sales and profit, then it might be a good idea to actually sell these assets and use the capital raised to either reduce debts or to invest it into more useful assets. Okay, so this is pretty much it, talking about the profitability ratios. And in the next video, we're going to have a look at liquidity ratios.